market timing is nearly impossible. If you get it wrong by a week, a month, a quarter, or even you miss the best day, you're going to hamstring your portfolio's return.
We're going to be highlighting an article that really stood out to us from this last weekend reading, and we wanted to dive a little bit deeper into it. I think it's one of the more timely articles, and it's one that really stood out to us as there really is just a couple lines in there that I thought, people got to hear this. Yeah. People have to hear this because I think it's so often overlooked, and it's such a common bias, and it's something that you might be actually experiencing today emotionally. This might even be conversations that you're having with your spouse, your friends, your financial advisor. So this article comes to us from the Best Interest blog, which is written by advisor Jesse Kramer. And it is titled The Perfectly Imperfect Investor. I mean, great title as well.
It's a great title.
This is a topic that you've probably heard several times. Right? You've heard, I can't time the market, can't time the market. You're a listener to the Retire with Purpose podcast. Yeah. You already are in there, right? You know, I'm not a market timer. That's not why I'm here. That's not why I'm listening. And I just want you to stick with us because this article does bring some unique perspective and a unique way of thinking about market timing and hindsight bias. But I think it sets it up in a different way that'll help you in your investment life.
And maybe it's not even help you. Maybe you've got this figured out. But this is something that you can teach friends, family. This is helpful advice for everybody. I thought for a minute there, Casey, you were talking about it being timely. I thought you were going to talk about the Monday morning quarterback thing because the NFL season's just about to gear up. It's almost NFL time.
Is it?
But
no, I didn't know. I thought it was about hunting season. That's all I know.
That's what you were watching. Yeah. So, the Monday morning, he kicks it off with the Monday morning quarterback theme, which, kind of refers to, okay, NFL games are on Sunday, on Monday. Is
this a thing, Monday morning quarterbacking? I didn't know.
I think it.
I never heard that phrase before.
Somebody that's frustrated with their team the next day, like, hey, once the game plays out, it's real obvious that they should have gone for 2, or they should have kicked a field goal, or they should have gone for it on 4th down. Because it's easy to look back. And what he's referring to there is a cognitive bias, which is hindsight bias.
Yeah, it's just all about criticizing things after the fact. Right?
Well, that's what fans do, right? That's what fans do. It's easy to criticize the team you love. I'm a Lions fan, so they're terrible.
You've had a tough go at it.
So I don't even criticize it anymore. It's just like, but hey, this is our year.
Yeah. Maybe. Well, and some are going to change their opinions after the fact altogether, right? Just change the opinion altogether so that your new opinion more closely matches how things actually unfolded, right? I got to say, saw this a lot following 2008 and still today. Like we'll meet somebody every once in a while that'll go, well, I knew the financial crisis was coming, so I got out of the market. I went to cash right before the market tanked. And just kind of beating their chest over, look how smart I am. You should be able to do this too. Right. And then 99.9% of the time it says, so what have you been doing for the last 15 years? And well, I haven't found the opportunity to get back in yet. I've just been waiting for that time. I think this is it. I think this is going to be the time. And you're changing some of that narrative where, well, why'd they get out of the market prior to 2008? Maybe it was just for them. It just felt like the right time to get out of the market. Did they really predict everything that was going to go on? I mean, highly unlikely, right? The best minds in the world didn't predict everything that was going to happen during the financial crisis. And creating explanations after the fact as well. That's incorporating events that happened to rationalize their decisions. And that's what I'm saying, right? I got out of the market because I knew the real estate market was about to collapse. I saw everything that was going on with derivatives and said, this is coming down in the next 6 months, right? And it's like, but is that really what happened? And sometimes it's not that we're lying, right? It's not a lie that's coming out of our mouth. It's a behavioral bias. It's a psychological block where We just naturally, as humans, we do think these things. It's an honest, earnest thing that we're saying. We believe this is how it happened. We believe this is what we were thinking. It's not that we're trying to deceive someone or be deceptive. Even the whole Monday morning quarterbacking thing, I've got to imagine you actually think, yeah, I was going to do that, or I was thinking about putting my money on this other team. I
should have done that.
Yeah, and you come up with these things that maybe weren't actually reality, but to you they are.
Mm-hmm. Right? And you're rationalizing those decisions you did or did not make, and it's natural. I think the most important thing here is recognizing that this is a bias, and we do change our opinions after the fact, that we do try to rationalize decisions that we make. And it's also helpful with spouses too, if I could say, because oftentimes spouses will maybe want to do one, and we see this in the investing world or personal finance, where it's like, well, I want to pay the house off. And then in hindsight, well, we could have used that money to do X, Y, or Z. And so understanding.
Well, think about yourself in a marriage argument, right? I mean, I've been guilty of that, right? It's like, well, no, you know what I was really thinking, and you know what I was going to do this, but you did that, so that's why I did this, right? We're really good at rationalizing things after the fact.
Well, and I see it this year. You talk about timely. If somebody, this author references a client who he'll call Peyton. Peyton's an 80-year-old, been in a 60-40 portfolio.
He didn't even say it's a client, but it's clearly.
Yeah, you're right. We both read this article. It's like, oh, he's speaking directly to somebody here.
Yeah, but this is a revenge article.
He's gotten some complaints from Peyton. Back in 2021, he's in the 60-40 split, right? 60% stocks, 40% bonds. Well, in 2021, the stocks vastly outperformed the bonds, right?
Which is even a pretty aggressive mix for an 80-year-old.
Exactly. Right? Yeah. I question the same thing. But, he was 60-40. If you looked at it in 2021, heck, we should have been 100% stocks. Mm-hmm. Now this year, being down the way things are, he feels like, well, he should be 100% in cash. He's looking at things through that hindsight bias, right?
Yeah. Over that period of time, stocks were up 13% a year over that decade. Stocks were up 13% a year over that decade. I mean, what an amazing year. That provided 7.8% of the total portfolio return, which was 8.4%, right? That accounted for the vast majority of it, because the 40% that was in fixed income averaged 1.5% a year over that decade. That accounts for only 0.6% of the 8.4% total portfolio return over that decade. So, yeah, he's going, why wasn't I 100% invested in stocks up to 2021? I would have made 13% a year instead of 8% a year. Well, this seems like you should have had this all dialed in and figured out. And then the second complaint is so ironic, right? I mean, complaint number 2 is portfolio's down about 10% this year. I don't like this. Why didn't you sell everything and go to cash at the beginning of 2022 and miss this crash altogether?
Yeah,
right?
It would be perfect, right? Yeah. That would be the perfect investor.
That'd be the perfect investor.
Good lead into this perfect investor, this idea of the perfect investor, right? Mm-hmm.
Yeah, and what's a perfect investor do? They're 100% stocks when the market's
are good.
At a bottom and everything's going up. Then they're 100% bonds or 100% cash and the market's at a local top. And yeah, I think there's another complaint that should go in there. If you're a 60-40 investor, I'm 60% stocks, I'm 40% bonds. I imagine this complaint is running quite rampant in the traditional investment worlds where your fiduciary advisor is only using 2 tools. That is stocks and bonds. You have stock ETFs, bond ETFs, or stock mutual funds, bond mutual funds. And you're going, wait a second, why is my safe money losing money, right? My bond portion of portfolio is losing. Why am I even in bonds? Why am I not more diversified so that we have some uncorrelated assets that don't go down when everything else goes down? My bonds are going down, my stocks are going down. Why wouldn't we incorporate some fixed assets, maybe even buy individual bonds, right? Buy individual bonds that we would have been concerned with the loss in value as interest rates went up. Buy fixed annuities paying 3-4% today that are returning bond-like returns without the risk to principal. Buying a fixed indexed annuity that can create a bond-like return without the interest rate risk. I mean, why not further diversify or further allocate those assets so you're reducing some of that interest rate risk? Right. We've been talking about interest rate risk for the last 15 years. Now, it just happened, right? It just happened. But it could have happened last year. We weren't trying to time when the interest rate risk is going to come into play and destroy the value of your bond holdings, but we knew this was a risk, so why not? And using some of Roger Ibbitson's research, right?
Like Wade Pfau, Roger Ibbitson, these folks that are spending an awful lot of retirement capital or research capital into understanding modern allocations. And you hear it all the time. Is the 60-40 dead? It's like, well, maybe it's supposed to be 60-20-20.
Hey, I know you're tuning in right now because you're all about leveling up. And we have an awesome way for you to do that, a free resource that goes out every single Friday, an email that hits your inbox. It's called Weekend Reading for Retirees. We distill down hundreds of articles to 4 articles on trending topics that can help you make better decisions about your retirement and your finances, both financial and non-financial. Not only will you get those articles with summaries and takeaways for myself, but you'll also receive special invitations to events, book giveaways, white papers, and so much more. Click the link in the description to sign up today. Right? You can still have some bond allocation, but why not have some alternative investments mixed in there as well? There's more than just stocks and bonds today. That if you're just investing in stocks and bonds, you're investing like it's the 1980s, right? The world has evolved, and so should your portfolio. So we've got complaint 1 and 2 here. Why wasn't I invested 100% in stocks up until the end of 2021?
Why wasn't I perfect? Yeah.
Why wasn't I perfect? Why didn't I go to cash at the beginning of the year? Really, he's saying, why didn't you do this, Jesse?
Yeah.
Why didn't you do this for me?
I'm hiring you to be the financial advisor.
I'm just inserting what I think could be a third complaint in there as well. But he really wants him to be a perfect investor, someone that times the market perfectly every time. He doesn't want him to be an imperfect investor. So let's look at the imperfect investor.
Yeah, first, they understand they cannot time the market. They don't know how the market will move today, tomorrow, this month, or this year, but they have faith that over decades, thousands of companies comprising the stock market will, on average, grow their revenues, and that's good for investors.
Mm-hmm. Yeah, they're not trying to time the market, and I think what makes them really irrational is that they know that cash or bonds tend to underperform the stock market, right? And they know the stock market tends to outperform bonds and cash. Mm-hmm. It doesn't even just tend to do it. Like if we're talking over 20, 30-year timeframes, we know that stocks have 100% of the time outperformed cash or bonds over a 30-year time frame. There's been some 20-year time frames where that wouldn't have been the case, but it still would have been pretty darn close to a break even there. But I want to say that we know that, right? We know that stocks outperform cash and bonds, but the imperfect investor still has cash and bonds. Mm-hmm. Why? I mean, that's irrational, right? That's not rational. It's not rational for me to hold an underperforming asset like cash or bonds, but they have their reasons for doing that. Maybe it's for an emergency fund. Maybe it's for rebalancing purposes. I would say more than anything else, they have a good understanding of their own risk tolerance. They're rational about that, right? Mm-hmm. Yes, it's irrational to not be 100% stocks, but they know that they're going to have some behavior that's not real good, right? They're going to have some other behavioral biases that will lead them to making mistakes, or at the very least, it's going to affect their quality of life because they know they can't mentally, behaviorally handle the risk of being 100% stocks. Yes, stocks outperform the bond market over the long haul. However, stocks can also be down 53% in a short period of time, and my psyche just can't handle that. They have a really clear understanding, I think, of who they are and what they need for themselves in their own unique world.
Yeah, and then he talks about the amateur investors. When he speaks to amateurs and non-investors, they often believe that the perfect investor is not only real, but they can be found at every advisory firm in America. They expect their financial professionals to resemble the perfect investor.
I don't know if they expected it to be at every advisory firm in America, but I mean, it's an expectation. And I think it's also an evolution that we're seeing in the investment and financial world, where that was what you went to an advisor for back in the 80s. And what was the point? It was for them to get you big returns and be an investor, right? You are an investor. I expect you to invest my money and get me good returns. And hence that results in what? I expect you to be able to time the market and beat the investor that's right next to you. That's what you're here to do, is manage my investments. I think today, I don't know that that's, I know that's not true. I don't think the majority of individuals are the amateur investor that believe that the perfect investor can be found in every advisory firm. I think more people today, even the majority of people today, are going to an advisor and looking for them to advise them on a financial plan. They're not looking them to just manage their investments. They want them to manage the big picture, create the big picture, create the income strategy, create the tax strategy, manage the estate plan, manage the investments. They want them to look at everything and try to customize a plan that's unique to their own personal situation and their own personal behavioral biases and their own psychology.
Yeah, I think that's a big point too, is trying to help make non-emotional decisions, right? That's what a good plan should do. And it points out here that the perfect investor does not exist, right? Timing the market is famously hard and impossible.
And here's this is that one thing. I told you there's going to be one thing that you're going to be like, wow, I didn't know that. Wow, that's powerful, right? I'm going to share that with my nephew or something, right? So what is that? Well, the stock market's returns often exhibit long tail behavior. That means a small number of the trading days account for a huge portion, massive, like not just a large portion, like massive portion of the overall return in your portfolio over the long haul. If we look at the S&P 500 from 1990 through 2019, you would have seen the S&P 500 that annualized 7.7% a year, excluding dividends. 7.7% a year, 1990 through 2019. Pretty darn good run, right? Now, what if you would have just hit the best day each year? What did that account for? If you were just invested one day each year on the best day of the year, you would have averaged 3.8% per year.
Pretty good. If you could figure that out and just get that one.
Just get that one day. That one day. Now,
even better if you get the best 2 days, right?
6.9% per year. What about the best 3 days, Marshall?
9.5% return if you were only invested on the 3 best days of the year.
3 best days of the year. Now, in other words, that means that just missing the 3 best days each year would turn an average investor's performance from 7.7% per year to a 1.8% annualized loss. Negative 2% per year over a time frame that is almost 30 years. Just shy of 30 years, you would have had a loss if you just missed the 3 best trading days every year. That in and of itself speaks volumes. And honestly, that is the core reason I wanted to share this article, because I think that hits hard.
Yeah, and that's where you have to have the takeaway, right? Market timing is nearly impossible. If you get it wrong by a week, a month, a quarter, or even you miss the best day, you're going to hamstring your portfolio's returns.
And so what is the best investor? Who's the best investor? It's probably a version of the imperfect investor. And
self-aware.
That's their biggest strength, right? They're self-aware. Right. And I don't want that to just float on by, right? That by far they are the most self-aware individuals. They understand their own behavior. They understand that they're probably going to get it wrong, right? I think, man, are they really that irrational? It seems like these are some of the most rational folks, pragmatic individuals that aren't trying to time the market. They understand their need for return and their risk appetite, right? We explain that as capacity, attitude, need. They understand what their capacity for risk is. They understand their attitude towards risk. They understand if they need the risk or not. They understand those things, and they accept that it's never going to be perfect.
Yes.
I'm never going to get every single thing right. They don't make perfect the enemy of good, because they know that their portfolio is designed for one purpose, and that is to experience life, right? It's not about growing that portfolio the most I can every single day. It's what do I need to do to be able to accomplish my goals and avoid the opposite, which is total failure.
Yeah, regardless of what the market does. I mean, that's the answer right there. Regardless of what happens tomorrow, the next day, a month from now, or 3 to 5 years from now, we have to have the confidence that we can live our life and do the things we need to